The only thing, as you mentioned, really the only similarity with 2007, or the most noticeable, is just the chart is hitting the all-time highs. The fundamentals are completely different. The valuations are completely different. When you look at small and mid-cap and how they're behaving, that's completely different. You know, we're really just talking more about, when we say the market, we're really just talking about the Dow and the S&P 500, those large caps that have been the winners. So for us, when you're looking at the full range of data points, when there's only one that's similar and the other 10 are different, to me, that doesn't indicate that this is going to be a top.
Yeah, and that in 2007, okay, 1999, obviously, Erin, was, you know, these fake internet companies, as we now know them, driving everybody, taxi drivers, buying these stocks.
Right.
2007 was all housing. It was all leverage. It was all, we know now that that was another fake economy. If this economy feels real.
Yeah, it does. I would say the only concern for us is that it's definitely been driven by growth more than value. You don't see quite as much breadth as we'd absolutely love. And so we could see these up and down sort of sideways patterns for a while, as long as growth is just so much favored. Because right now, when you look at the S&P 500 growth versus value, growth is outperforming by almost 12% year to date. We're only 7 months into the year. So that's actually the biggest spread we've ever seen since we've ever been tracking style indices. And so that's a bit of a concern, is that it's clearly led by growth. Value is so out of favor. And for us, we would like to see a bit more breadth and some more of the value stocks actually holding up and doing a little better to really keep this market going.
But is that a reason to be skeptical of the bull run?
No, I think it goes back to what Mike said earlier. I mean, it's very geriatric in terms of the way this market's gone. It's been such slow growth. I think it's the slowest growth we ever had historically. And, you know, we forget, too, as going back to the little guy, Mike, not being in the market, there's like $9 trillion sitting in cash right now. Like, nobody's been in this market for almost 10 years. I mean, most investors have missed the boat. So I have to think that once we get, you know, past these trade wars or whatever trade concessions we get, which I think we're going to get, you know, you could really have a big capitulation to the upside here. I mean, I think that's the biggest risk we have in the market today.
I don't think that's inconsistent with this kind of late move, right? This is the Paul Tudor Jones type scenario that he set up. It's a late 90s feeling like, well, you have this wall of worry, we have to kind of get back above it, and then this all-in explosive move, if that wasn't what we got in January. And again, that's tactical stuff. If 2019 earnings estimates come through as they're now on paper and we don't get that typical erosion of forecast, Erin, there's not going to be a lot to argue with.
No, we haven't had any erosion for this year. In fact, it's just keep going up for 2018. We're up to 23%. So if we get another 9% next year. Another thing is also the revenue estimates are looking really solid. We're looking at about 5.5% revenue growth for next year. If we get that, it's not going to be the end of a bull market.
But what is the typical pattern, right? So if in August of any given year,
what is typical these days?
What you normally lose a few percentage points of anticipated growth for the following calendar year, right? So if next year is 5%.
You usually lose it lose it in the first quarter or the second, and then it pops back up.
Got it.
Except for some of the really bad years, you lost it in the first half of the year and it never came back.
Too far.
Many in the market, Ryan, have been guilty of overestimating or underestimating, I guess, the risks of certain things in 99 and 2000, right? Everything's fine, subprime is contained, the internet's going to be okay, everything's fine. Are we also maybe underestimating the ability of things to remain good for a while? Just because we're so good now, there's this, I think we've been so scarred from the last 15 years that we just can't believe things will continue. There must be something wrong.
That's what blows my mind, this whole bull market, and I deal with the retail investor every day, is they just don't believe it. I mean, it doesn't matter how good the economic data comes in. Can you blame them?
They've been beaten up twice massively in the last 15 years.
Oh, it's definitely scar tissue. I mean, you couldn't put better numbers in front of people, and it's still, but wait a second, what about trade wars? Oh, wait a second, what about the inverted yield curve? It's like, come on, look at the numbers. By the way,
just one quick note. I think there's a lot of hindsight sense that the 90s, everybody was happy all the time. Nobody saw the 90s. It wasn't the case. You had 97, 98, you thought the world was going to end. It was a global margin call twice. And all the way, people said, this internet stuff is crazy, right?
Which it was.
And it was. So my point is, people weren't comfortable, even though it was a lot of easy money for the last couple of years of that run. It wasn't as if the entirety of the 90s. By the way, Greenspan was considered blowing a bubble the whole decade, right? How could short-term rates be kept at 3%? It's too low. That's what you heard in the middle of the 90s.
And now we hear 0%.
You had the anxiety then, too.
Yeah, you always do, right? And that's the thing. When we look back, we're going to say this was so easy to be invested the last decade, but it was really, really hard.